can you assign a rough percentage down from here? And again, the question is really kind of like, hey, we see things getting worse. How bad could it get? And can you give me a percentage number? No, that's not what we do here, right? We look at things from a mathematical standpoint, and as of this morning, the immediate term downside is minus 2.29% on the S&P 500. So we don't do kind of random price targets or try to try to just randomly pick a 15% downside or 10% downside from here, 12, whatever the number is, right? It's very specific. You just heard me say it said minus 2.29%. It's a very specific number. We're all about the details, right? And so, please, kind of rejigger the question. Now, I think, not to harp on this individual, I forget who it was, but Vic from Saratoga says, Vic, again, I'm not harping on anybody. I'm just trying to get everybody better here. I think, again, perhaps a better twist to that question, because it is good to be thinking on a trend and tail basis, right? So better kind of phrase of that question, and one that I will propose to Keith and hopefully get an answer for by the new year is, your immediate term downside for S&P is 2.29% today. Could you provide either the full risk range or at least the low end of the risk range on both the trend and tail duration for S&P, the composite the NASDAQ, the CompQ, and or Russell, right? And let him, either give it to us or not. So, I think that's perhaps a different way of, or a better way of phrasing that question, because I think that's really what you were getting at, is what is the math, on the downside in regards on a trend and tail basis. So on a longer duration, where could this thing go? So, make sure you're thinking in those contextualizing those questions in perhaps a little bit of better framework, and we'll get more information out of Keith and better answers out of Keith. I will just say, from a pre-pandemic bubble peak standpoint, it's about 12% downside. So that would have been kind of late 2019 as of yesterday's close. But really, let's let the math guide us through this process, and I'll come back with some good, hopefully some good ranges there for you on those core indices. The other component too here, and Genron on slide 13, and then we'll go to 14. I just want to reiterate that, these cycles can really last longer than just what the quad 4 might look like on the map, right? So in the growth bubble peak, this is of the S&P 500, the SPX, in the growth bubble peak there in the 2002, you had down years of -9, -11, and -24 in terms of like each year to date number, and an aggregate kind of -20 across Q4 2000 to Q4 2001. So again, we're sitting at about a negative, about negative 20%, I think, on the S&P, close to it, minus 19.80 year to date basis on the S&P. And we're minus 33.04% on the NASDAQ. So if you go to that next slide, Genron, kind of give you a good idea. This is more on the NASDAQ here. So again, start off with a minus 38% number year to date in 2000. Then we went to minus 26 in 2001 and minus 39 in 2002. So those are the year to date moves across the NASDAQ across 3 years. And again, just wanted to reiterate, I've shared this slide. I think it might have been even on episode 1, but the quad 4s on the board might not still be there, but the signal inside the market is really going to be our guiding light, and has been, and will always be, the signal trumps the quad, right? So the signal will continue to help us with our asset allocation and our tactical moves within, and keeping us dynamic. So, but I did just want to reshare these slides, kind of looking at the last sort of bubble peak, the growth bubble peak of the 2002 cycle.